In January 2021, something happened on the internet that had never happened before. A group of amateur investors coordinating on a Reddit forum called WallStreetBets decided to buy shares in a struggling video game retailer that professional Wall Street hedge funds had bet billions of dollars against. The hedge funds were certain the company was dying. The Reddit crowd decided to prove them wrong, or at least make them pay for being right. In 3 weeks, GameStop's share price rose from $17 to $483. Hedge funds that had shorted the stock lost billions. One firm, Melvin Capital, required a $2.75 billion emergency bailout and eventually collapsed entirely. A 27-year-old Massachusetts man who had spent years publicly investing his life savings in GameStop became a folk hero, with millions of followers and a congressional testimony. For one extraordinary moment, a group of people on the internet had beaten Wall Street at its own game. The establishment had been humiliated. The little guy had won. GameStop's market capitalization hit $30 billion. The company was worth more than it had ever been, built entirely on the collective will of retail investors who believed, or at least wanted to believe, that the story wasn't over. It was a once-in-a-generation moment of financial populism, a genuine upset, an actual David versus Goliath story with receipts. GameStop then spent the next 4 years squandering every single advantage that moment created. To understand what GameStop threw away, you first have to understand what it genuinely was. For an entire generation of young people, GameStop was the place where gaming culture lived in physical form, not just a retailer, a destination. You went to GameStop not only to buy games, but to trade them, argue about them, and get recommendations from staff who had actually played everything on the shelves. The used game ecosystem, buy a game, finish it, trade it back for credit toward the next one, was a genuinely consumer-friendly model that made gaming financially accessible to millions of kids and teenagers who couldn't otherwise afford new releases at full price. The midnight launch events were their own institution. Lines around the block at 11 p.m. for a major release. The specific excitement of being handed a game the moment it was technically available. A social ritual built around a shared obsession. For a certain generation, GameStop's blue and yellow signage triggered the same Pavlovian response that McDonald's golden arches triggered for another. At its peak in 2008, GameStop had over 6,700 stores worldwide and $9.1 billion in annual revenue. It was the dominant force in video game retail, with a used game business that competitors struggled to replicate and a loyalty program that kept customers coming back with the reliable efficiency of a well-designed trap. And then, with a speed that felt almost personally offensive to the people who loved it, the model collapsed. GameStop's business was built on physical media at precisely the moment physical media began to disappear. The used game model, the crown jewel of GameStop's economics, depended entirely on games existing as physical objects that could be owned, sold, and resold. When publishers began offering digital downloads directly to consoles, they weren't just offering convenience. They were eliminating the secondary market that GameStop depended on for its highest margins. A digital game cannot be traded in. A downloaded title cannot be sold back. Every shift toward digital distribution was a direct attack on the most profitable part of GameStop's business model. Microsoft and Sony understood this perfectly. Their push toward digital game sales was not incidentally harmful to GameStop. It was structurally hostile to it. The console manufacturers had every incentive to eliminate the used game market because every used game sale was a sale that generated zero revenue for the publisher. GameStop's entire value proposition was built on an ecosystem that the most powerful players in the industry were actively working to dismantle. By 2019, GameStop's annual revenue had fallen from that $9.1 billion peak to $8.3 billion, and declining sharply. Stores were closing, the used game margins were compressing. The company had cycled through multiple CEOs in search of a strategy that could work in a world of digital distribution, and found none. The hedge funds shorting the stock weren't wrong about the fundamentals. They were just about to be temporarily, spectacularly humiliated. The short squeeze of January 2021 didn't save GameStop, but it gave GameStop something that, in the hands of a competent management team with a clear vision, could have been transformative: time, money, and the world's attention simultaneously. At the peak of the frenzy, GameStop's elevated share price allowed it to raise over $1.6 billion in capital through stock offerings. This was real money, available at a moment when the entire world was watching to see what the company would do with its unexpected second chance. The goodwill of millions of retail investors, people who had literally put their own money on the line, out of loyalty to the brand and rage at the institutions that had written it off.
When GameStop was actually gaining traction, the price was like, oh my God, it went up to like 300. Did I put in all of my savings into it?
Was an asset with no precise monetary value, but enormous practical potential. What GameStop needed to do with that moment was obvious to almost everyone watching. Hire transformational leadership with a credible vision for what GameStop could become in a digital world. Invest aggressively in building the platform, the community, and the ecosystem that the brand's loyal base was desperately hoping for. Use the capital to execute a genuine reinvention before the meme energy faded and the fundamentals reasserted themselves. What GameStop actually did was appoint Ryan Cohen, co-founder of the pet food e-commerce company Chewy, as chairman, pivot toward an NFT marketplace, and spend 2 years moving slowly, while the window that the short squeeze had opened began to close. The NFT marketplace launched in 2022 and was shut down in 2023, having generated negligible revenue and significant ridicule. The broader crypto and NFT market had collapsed in the interim, taking whatever logic had underpinned the strategy with it. Hundreds of millions in capital had been spent, thousands of stores had been closed. Headcount had been cut repeatedly in rounds of layoffs that generated negative press without producing a coherent alternative vision. By 2024, GameStop had approximately $4 billion in cash on its balance sheet, the legacy of those 2021 stock offerings, and no clear plan for what to do with it. The company was profitable in a narrow technical sense, having cut costs aggressively enough to generate modest, positive earnings on dramatically reduced revenue. But profitability through contraction is not a strategy. It is a managed retreat dressed up in an earnings release. Then, in 2024, Ryan Cohen announced that GameStop would begin investing its cash reserves in stocks and other financial instruments, essentially converting the company from a retailer into something closer to an investment vehicle. The announcement was met with the particular kind of bewildered disappointment that comes from watching someone who had every opportunity to do something meaningful choose instead to do something inexplicable. The company that had been handed $1.6 billion and the goodwill of millions of retail investors had decided its best use of capital was to become a hedge fund. The irony of this, Anam, given that the entire GameStop story had begun as an uprising against hedge funds, was either completely lost on the people making the decision or entirely understood and simply not cared about. In January 2021, GameStop's share price hit $483. In early 2026, it trades at around $25, down over 90% from the peak and barely above where the short squeeze began. Annual revenue has fallen from $9.1 billion at peak to approximately $3.8 billion, with continuing declines each year as store closures compound and digital gaming penetration increases. The company has closed thousands of locations since 2019. The remaining store count is a fraction of what it was at the height of the brand's cultural relevance. The $4 billion cash pile, the one genuinely valuable asset the short squeeze left behind, is being deployed into financial markets rather than into building anything. The NFT experiment is a closed chapter. The transformational leadership that might have used the moment never arrived. Keith Gill, the retail investor who became the face of the 2021 squeeze and whose conviction had inspired millions of people to bet on GameStop's future, returned briefly in 2024 to significant fanfare, revealing a massive GameStop position. The stock spiked, Then it fell. The pattern of the entire story repeated itself in miniature. The short squeeze of 2021 was one of the most extraordinary events in the history of retail investing. It was funny, it was righteous, it was genuinely subversive, and for a brief and electric moment, it felt like something real had changed. GameStop was handed a miracle: capital, attention, goodwill, and time. All at once, all when it was needed most. The hedge funds that had bet against it were embarrassed. The establishment had been shaken. The company had every resource it needed to become something worth the faith that millions of people had placed in it. It chose not to. That is not Wall Street's failure. It is not the hedge funds' failure. It is not the fault of the retail investors who believed. It is the failure of a management team that was handed the most improbable second chance in retail history and responded with an NFT marketplace and a pivot to stock picking. GameStop didn't get killed by digital downloads or short sellers or an indifferent market. It respawned. It had full health. It had the coins. And then it walked off the map.